In 1925, if you walked into a bank and asked for a mortgage to buy a house, here is what a typical loan looked like. The bank might lend you half the purchase price. You needed the other half in cash, up front. The loan lasted perhaps 5 years, and in most cases you did not pay it down at all. You paid interest only, and at the end of the term the entire principal came due at once, in a single crushing balloon payment that most families could never hope to save. So you did the only thing you could do. You refinanced, rolled the debt forward, and prayed that when the note came due again, the bank would still be willing and still be open. The 30-year mortgage, the fixed monthly payment, the loan that slowly becomes a home you own, none of it existed. It had not been invented yet. And the credit card? The little rectangle that now sits in nearly every wallet in America, the device that moves trillions of dollars a year? In 1949, there was no such thing. Not one. The first true charge card in history would not appear until 1950, which means the credit card is younger than many people watching this video's parents. There are people alive today who are older than consumer credit as we know it. Yet somehow, before any of this existed, Americans bought farms and houses. They opened stores and built factories. An entire continent was settled, cleared, planted, and industrialized by people who, by our standards, had almost no access to borrowed money at all. So how did a young couple in 1890 buy a home? How did an immigrant with $40 open a shop? How did a farmer survive from planting to harvest with no cash and no card? Where did the money come from? And what did it cost, in dollars and in dignity, to get it? The answers are stranger than you might expect. They involve a general store ledger that functioned as a private credit file on every family in town. A secret national spy network, founded by an abolitionist, that compiled reports on the character of millions of Americans, with correspondents who included a young lawyer named Abraham Lincoln, a sewing machine company that accidentally invented the modern installment plan. Neighborhood societies where working men pooled pennies to build each other houses, one at a time. Loan sharks who owned the paychecks of entire city workforces. A depression that foreclosed on 1,000 American homes every single day. And a bank in California that one morning in 1958 dropped 60,000 unsolicited credit cards into the mailboxes of a single city and set off a chain reaction that rewired the financial life of the world. Because here is the truth hiding inside this story. Credit is not really about money. It never has been. Credit is a technology for answering one question: can this person be trusted? And the history of how Americans answered that question, first with handshakes, then with ledgers, then with spies, then with machines, is the hidden history of American life itself. To find it, we have to start in the place where most Americans actually got their credit for 100 years. Not a bank. Almost never a bank. A store, picture a general store in a small American town around 1870. Barrels of flour and crackers, bolts of cloth, kerosene, nails, coffee, boots. And behind the counter, more important than any of the merchandise, a thick ledger book. That ledger was the true financial institution of 19th century America. Because most customers did not pay cash. They bought on account, on the book as the phrase went, and settled up when money came in. After harvest, after the hogs sold, after the pay packet arrived. The storekeeper carried his community for months at a stretch. In farm country, he might carry them for the entire year, from spring planting to fall settlement, taking payment in crops as often as coin. The rhythm of this economy had its own calendar, and its great festival was settlement day. In farm regions, when the crop money came in, often just once a year, families drove to town to square the book. The year's flour, cloth, coffee, and nails on one side, the year's butter, eggs, hides, and cordwood the family had traded in on the other, and cash or crops to cover the difference. Because that was the other thing modern eyes miss. The ledger ran in both directions. The storekeeper was not only a lender but a buyer, taking farm produce against the account and shipping it onward, which made him banker, broker, and commodity dealer rolled into one apron. Actual currency might touch the transaction only at the very end, if at all. Economic historians who have worked through surviving store ledgers find whole communities functioning year-round on this web of book entries. A cashless economy, not as a futurist's dream, but as everyday 19th century fact. Understand what this meant. The storekeeper was the loan officer of ordinary life. He decided family by family who got credit and how much, and he made that decision the only way it could be made in a world without credit bureaus, by knowing everyone. He knew who worked hard and who drank. He knew whose farm was mortgaged, whose son had gone to the bad, whose word was good. His ledger was a credit file, his memory was the algorithm, and his judgment could quietly determine whether a family made it through a bad year. That is the first great secret of the credit card question. Before credit cards, most Americans lived on credit constantly, more intimately than we do now. The difference is that their credit was personal. It had a face. You did not carry a card that any merchant would honor. You carried a reputation that one merchant would honor, and everything depended on keeping it. In the South, after the Civil War, this system hardened into something far darker. With the region's banks destroyed and cash scarce, the crop lien became the engine of rural life. A farmer, very often a black sharecropper or a poor white tenant, pledged his future cotton crop to the local furnishing merchant in exchange for supplies on credit, at credit prices that ran far above cash prices, with interest rates that scholars of the period have documented at levels that startle modern readers. When the crop came in, the merchant settled the account by his own books, and year after year, on farm after farm, the settlement came out the same way, still owing. The lien rolled forward, debt compounded, and a legal form of perpetual dependency settled over much of the rural South for generations. The same ledger technology that carried a Midwestern family through a hard winter could, under different power arrangements, become a cage. Credit has always had both faces. It still does. Meanwhile, for the urban poor, the most important lender in the neighborhood hung 3 golden balls over his door. The pawnshop was, in the memorable phrase historians have attached to it, the poor man's bank, and the description was literal. In an era when no bank would lend a working man $5, the pawnbroker would, instantly, against a coat, a watch, a wedding ring, a set of tools. Pledges flowed in on Monday and were redeemed on Saturday when wages came, week after week, a rhythm so regular that pawning the Sunday suit each Monday morning became a documented routine of working-class life in American and British cities alike. It was expensive credit. It was also, for millions of families, the only shock absorber that existed between a lost week of wages and genuine hunger. Below the pawnshop, in the shadows, waited something worse. In the growing cities of the late 19th century, a new predator evolved, the salary lender, the original loan shark. His customer was the respectable clerk or working man with a steady paycheck and a sudden emergency. The loan was small, the price was not. A common arrangement was known on the street as 5 for 6, borrow $5 on Monday, repay 6 on payday, which sounds almost quaint until you calculate what a 20% charge per week compounds into across a year. The lender secured himself with a legal assignment of the borrower's future wages, which gave him a weapon better than any collateral, the threat of humiliation. One letter to the borrower's employer. Many companies fired wage-assigned workers on the spot, and the debtor's livelihood was gone. So the debtor paid and borrowed again and paid again. Reform investigators in the early 20th century found offices of these lenders clustered near factories and railroad yards in every major city, holding, in some documented cases, astonishing shares of a workforce's paychecks in their files. The problem grew so notorious that it eventually forced one of the most counterintuitive reforms in American financial history, one we will come to shortly, in which reformers concluded that the only way to kill the loan shark was, of all things, to legalize higher interest rates. So this was everyday borrowing in the world before cards. The storebook, the pawn ticket, the wage assignment. Personal, local, and priced by desperation. But a question should be nagging at you. All of this explains groceries and emergencies. It does not explain the big things. It does not explain how a family bought a house or how a man with an idea opened a business. For that, 19th century America built machinery of a completely different kind, and one piece of it began with a New York silk merchant, a moral crusade, and a filing system that would quietly become one of the most powerful private archives on earth. His name was Lewis Tappan, and before he changed the history of credit, he was one of the most hated men in America. Tappan and his brother Arthur were wealthy New York silk merchants and among the most prominent abolitionists in the country, founders of anti-slavery societies, financiers of the legal defense in the Amistad case, men whose names on a cause guaranteed both money and mobs. Their store was attacked. Lewis's house was sacked by a pro-slavery crowd who burned his furniture in the street. Southern business dried up. When the Panic of 1837, one of the great financial collapses of the century, swept away thousands of merchants and left the Tappan's own firm buried in uncollectible debts owed by distant customers they barely knew, Lewis Tappan absorbed a lesson that would outlast all his crusades. The fatal weakness of American commerce was that nobody knew who was safe to trust. Think about the problem from a wholesaler's desk in New York. A man walks in claiming to own a store in Ohio and asks for $5,000 of goods on 6 months' credit. Is he a rising merchant or a fraud? In 1835, there was no way to know. You could write letters and wait weeks. You could rely on a chain of personal introductions. Or you could guess, and in 1837, the guessers died in droves. Tappan's solution, launched in 1841, was called the Mercantile Agency, and it was as simple as it was audacious, a permanent national network of local correspondents. Attorneys, merchants, postmasters, bank cashiers in towns across the country who would send confidential reports to New York on the businessmen of their districts, their character, their habits, their assets. Whether they drank, gambled, paid promptly, kept their word. The reports were copied by rows of clerks into massive ledgers in New York, indexed, updated, and sold. Not published, but read aloud or summarized to subscribing merchants who want to know whether the man from Ohio was good for $5,000. It was, in effect, a private intelligence service aimed at the entire American business class. And it worked. Subscribers multiplied. Branch offices opened. Competitors emerged, most importantly the Bradstreet Agency, which pioneered publishing credit ratings in book form. The descendants of these two rivals would eventually merge into a firm still famous today, Dun & Bradstreet. By the later 19th century, the successor agencies held files on more than 1 million American businesses, graded and rated, and no serious wholesaler extended credit without consulting them. The correspondent network, meanwhile, brushed against history in ways that still delight researchers. Among the local attorneys who supplied reports to the agency in its early decades was a young Illinois lawyer named Abraham Lincoln. The future president, moonlighting, in a small way, as a credit informant. Pause on what had actually been invented here, because it is the hinge of this entire story. Tappan had discovered that trust could be industrialized, that the storekeeper's personal knowledge, who is reliable, who is a risk, could be extracted from the town, written down, centralized, and sold to strangers. The customer being evaluated never saw his file, rarely knew it existed, and had no way to correct it. A hostile or careless correspondent could quietly strangle a man's commercial life. Every debate we now have about credit bureaus, data brokers, and algorithmic scoring. Accuracy, secrecy, power without accountability was already fully formed in those Manhattan ledgers before the Civil War. We did not invent the surveillance of financial reputation in the computer age. We computerized an institution that abolitionist New York built with quill pens. The mercantile agency solved trust between businesses. But the man from Ohio still needed something else before he could stock his store. Capital itself. And here we meet the great structural surprise of 19th century business finance. The thing modern viewers never guess. Banks did not finance new businesses. Not the way we imagine. A national era or state bank of that period was, overwhelmingly, a dealer in short-term commercial paper. 60-day and 90-day loans, financing goods in transit and crops moving to market, extended to established merchants with names the directors knew. A long-term loan to launch an untested venture was considered unsound banking almost by definition, and a loan to a stranger without local standing was nearly unthinkable. Bank credit was a club, and the membership committee was the board of directors, who were usually the town's leading merchants lending, with serene confidence, to themselves and their friends. Historians of banking describe the pattern bluntly as insider lending, and in that era it was not a scandal. It was the system, and by concentrating capital on known quantities it arguably even worked, if you were inside. The human face of this club system was the country banker, a figure worth a portrait because he governed small-town capital for a century. He lent, in the standing phrase, on the 3 C's: character, capacity, capital, and the order was not accidental. Character came first because it was the only one he could truly verify, and he verified it by living next to it. He knew a borrower's habits the way the storekeeper did, and he priced accordingly, or declined accordingly, with no appeal, no second opinion, and frequently no other bank in town. Main Street literature is full of him, alternately as pillar and as petty tyrant, and both portraits were drawn from life. What he almost never did was take a risk on a stranger, an innovation, or anyone outside the local web of reputation, which is precisely why so much of this story happens outside his lobby. So where did outsiders get the money to start something? The answer is the invisible capital market of the 19th century. Family and partnership. Savings accumulated across a generation. A father staking a son. Brothers pooling inheritances. And above all, the partnership. The young man with energy matched to the older man with capital. Profits split by contract. Read the origin story of almost any famous American fortune of that century, and you find not a bank loan but a chain of human relationships. Apprenticeship, then clerkship, then a partnership stake, often financed by the senior partner himself. Business credit, like store credit, ran on the same scarce fuel. Personal reputation. Personally verified. The mercantile agency existed precisely because that fuel did not scale to the size of the continent. For immigrants outside these networks entirely, communities imported their own machinery. Jewish neighborhoods built Hebrew free loan societies, lending small business capital at no interest against nothing but 2 cosigners' names, with repayment rates, their records show, that any modern bank would envy. Chinese immigrants operated rotating credit associations, the Hui, in which members paid into a common pot that each took turns claiming, funding laundries and restaurants up and down the West Coast without a single bank's involvement. Italian, Greek, Japanese, dozens of other communities ran variations of the same design. One Italian immigrant in San Francisco, Amedeo Giannini, became so convinced that ordinary working people were the great untouched banking market that in 1904 he founded a small institution aimed at them, the Bank of Italy, which lent to fishermen, fruit peddlers, and laborers the establishment banks would not receive, famously set up a plank and barrel desk on the street to make loans days after the 1906 earthquake, while grander banks stayed shut, and grew decade by decade into the Bank of America. Keep that name in mind. It returns at the climax of this story, holding 60,000 envelopes. And what about the biggest purchase of all, the American home? Here the 19th century built its most beloved and most misunderstood institution, one immortalized by Hollywood in a film everyone has seen and almost no one fully understands. Before we reach the houses of the towns, we owe an answer on the purchase that dwarfed all others in the 19th century: land itself. For most American families of that era, the home was a farm, and the farm began as a piece of the public domain. And here, the very first lender many settlers ever met was the federal government, an experiment that ended in the young republic's first great credit catastrophe. Under the land laws in force from 1800, a settler could buy federal land with only a fraction down, the balance owed to the government land office in installments over 4 years. It was a national layaway plan for a continent, and in the flush years after the War of 1812, it ignited a speculative frenzy. Land office business entered the language as a phrase for booming trade, with settlers and speculators alike pyramiding claims on borrowed money against the collateral of ever-rising land prices. Then came the Panic of 1819, the nation's first true peacetime financial collapse. Commodity prices fell, the credit chain snapped, and suddenly tens of thousands of families owed the United States government for land worth less than their debts. Millions upon millions of acres in arrears. The politics were poisonous, the government as foreclosing creditor of its own citizens. Congress retreated, passed relief acts, allowed debtors to surrender land against what they owed, and in 1820 abolished the credit system entirely. From then on, federal land sold for cash. The government had learned, painfully, the first lesson of this entire story. The lender's power over the borrower is a dangerous thing for a republic to hold over its own voters. Cash sales pushed the credit problem into private hands. To the squatters' claim clubs, to moneylenders charging frontier rates against land warrants, to the eastern capital that flowed west through mortgage brokers. And then, in 1862, the same summer that produced the income tax, Congress produced the most sweeping answer ever given to the question of how ordinary people afford property. It stopped selling the land. The Homestead Act offered 160 acres to any citizen or intending citizen who would live on it and improve it for 5 years. The price was labor, endurance, and a small filing fee. Measured one way, it was the largest credit substitute in history. Property without purchase, capital granted against a promise of work. Measured honestly, it also rested on the dispossession of the native nations whose land it distributed, and its benefits, like those of every credit system in this story, flowed unevenly. But its scale is beyond argument. Hundreds of thousands of families ultimately proved up claims, and a vast share of American family farms traced their titles to it. For everyone buying land from another private owner, and as the frontier closed, that became everyone. The workhorse was an instrument now almost forgotten: seller financing. The land contract, the purchase money mortgage, the note held by the seller himself. A retiring farmer did not get a check from a bank. He became the bank, taking the young buyer's note and living on its payments, often for the rest of his life. Deed records across rural America are full of these arrangements. Two families bound together for a decade by a single piece of paper, no institution anywhere in sight. It was mortgage lending as a relationship between neighbors, with all that implied. Flexibility in a bad year if the seller was decent, and ruin if he was not. If you have watched It's a Wonderful Life, you have seen a building and loan association. George Bailey's shabby little office, forever one bank run away from ruin. What the movie does not tell you is that institutions like the Bailey Brothers Building and Loan were, for ordinary Americans, very nearly the only road to homeownership that existed, and that the road was invented not by financiers, but by working men solving their own problem. The first American building and loan was organized in 1831 at a tavern in Frankfort, Pennsylvania, outside Philadelphia, on a model imported from England. A group of neighbors, weavers, tradesmen, clerks agreed to pay small fixed sums into a common fund every month, and as the fund grew, it was lent out to members one by one to build or buy homes, with the borrower's repayments replenishing the pool for the next member in line. The earliest societies literally terminated when every member had been housed. It was homeownership as a mutual aid project, a bucket brigade for capital. The model spread across the country through the late 19th century into thousands of local associations, holding the savings of millions of families, and it carried a quiet radicalism the participants themselves understood. At a time when commercial banks regarded a workingman's mortgage as beneath consideration, the building and loans lent higher fractions of a home's value for longer terms, repaid in level installments that a wage earner could actually plan around. The seed of the amortized monthly payment that the rest of the mortgage world would not adopt for another 2 generations. They were governed by their members, rooted in neighborhoods and often in immigrant and ethnic communities, and marketed with open moral fervor, thrift, independence, a stake in the country. When Frank Capra made George Bailey's speech about people doing most of their working and paying and living and dying in this community, he was not inventing sentiment. He was quoting almost the actual language of a movement, but most American mortgages still came from elsewhere, from savings banks, insurance companies, private investors, and mortgage companies. And for those borrowers, the standard product was the instrument we opened this story with, the short balloon mortgage. 5 years, sometimes 3, sometimes 10, half down, interest only, or nearly so. Principal due in full at term, in the confident expectation of refinancing. Layer onto this the farm mortgage belt of the plains, where Eastern money flowed through mortgage brokers into Kansas and Nebraska land in the 1880s boom, and was incinerated in the busts that followed. And you have the American housing finance system as it stood in 1929. Local, fragile, short-fused and wired through those balloon payments directly to the health of the banking system. In 1920s prosperity, the wiring held and even sparkled. Home ownership climbed. Developers borrowed through an exuberant new market in real estate bonds sold to small investors. Skyscrapers and apartment blocks financed retail, a detail that will sound eerily familiar to anyone who lived through 2008. That bond market deserves a closer look because it is one of history's cleanest dress rehearsals. Through the 1920s, real estate bond houses sliced the mortgages on office towers, hotels, and apartment blocks into small denomination bonds and sold them to ordinary savers with soothing slogans about the safety of real estate. Marketing that reached deep into the middle class, promising the security of a mortgage with the convenience of a coupon. Billions flowed in. Buildings rose against the proceeds, and the quality of what was being financed sagged unseen beneath the confident paper. When the Depression came, the sector did not merely decline, it disgraced itself, with defaults sweeping the industry, bondholder committees discovering self-dealing and fictitious appraisals, and small investors wiped out by the hundreds of thousands. Investigations followed. The affair helped fuel the securities laws of the early 1930s. Then the whole episode was forgotten so completely that when mortgage securitization returned 2 generations later, it arrived wearing the halo of innovation. Financial memory, this story keeps teaching, is about 1 lifetime long. Then, in the fall of 1929, the market crashed, the economy followed, and the entire structure detonated in slow motion. Follow the mechanism, because it explains everything that came after. Depression strikes, incomes fall, a family struggles but might still manage a payment or two. But the mortgage is a balloon, and it is coming due. Renewal was always the escape hatch, and now the bank, itself besieged by depositors and dying loans, cannot renew. It needs its money back from a borrower who has none, secured by a house whose price is collapsing. Foreclosure follows, which dumps another house onto a dead market, which lowers prices further, which pushes the next loan underwater, which fails the next bank, which calls the next balloon. By the worst stretch of 1933, American lenders were foreclosing on homes at a rate widely cited at around 1,000 per day. Roughly half the nation's home mortgage debt was in default. In the farm states, foreclosure sales were being physically stopped by crowds of armed neighbors who bid pennies, returned the farm to its owner, and made clear that higher bids would be unwise. The penny auctions, one of the era's great gestures of communal defiance. Several states simply declared moratoria and shut foreclosures down by law. The housing finance system of the old America was not reformed in the 1930s. It died. And what replaced it was designed, piece by piece, in Washington, creating the mortgage you probably have or hope to have. Today, in 1933 came the Homeowners Loan Corporation, a rescue agency that bought defaulted mortgages from lenders and refinanced more than 1 million of them on terms most borrowers had never seen. 15 years, fixed rate, fully amortized, every monthly payment retiring both interest and principal, so that the loan steadily extinguished itself and the balloon simply ceased to exist. In 1934 came the Federal Housing Administration, which took the next logical step. Rather than lend, it insured private lenders against loss on mortgages meeting its standards, and its standards became the new American mortgage. Long terms stretching eventually to 30 years, low down payments, level monthly payments, amortization to zero. Protected from catastrophe by federal insurance, lenders who would never have touched a 20-year workingman's loan in 1928 were originating them by the millions a decade later. In 1938, Washington added Fannie Mae to buy insured mortgages and keep lenders' funds turning over, and in 1944, the GI Bill extended the model to a generation of veterans with the VA guarantee, down payments that rounded, in many cases, to nothing. The results rank among the largest social transformations in American history. The homeownership rate, which had drifted for decades in the low to mid 40% range and sagged during the Depression, surged after the war, through 50%, past 60 by 1960, as the suburbs boomed and the 30-year mortgage became not a product but a birthright. The modern American middle class, with a house as its savings account and its inheritance, was built on that federal architecture. When people today speak of the traditional mortgage, they are describing a government invention younger than sliced bread. But the architecture had another face. An honest history has to look at it. The OTC and the appraisal culture of the era produced city maps grading neighborhoods for lending risk, and the grades tracked race explicitly, with black neighborhoods and racially mixed areas marked in red as hazardous. The FHA's own underwriting manuals, for years, warned against insuring loans in such areas and favored racial homogeneity, and the agency declined to back mortgages in red-line districts on a massive scale while pouring guarantees into white suburbs whose deeds, in countless developments, barred sale to black buyers outright. The word for this, redlining, comes from those maps. The consequence was that the greatest wealth-building machine ever aimed at the American middle class was, for its first decades, largely closed to black families, a closed door whose compounding effects on family wealth scholars still measure in the present tense. The same lesson we met on the Southern crop lean returns at national scale. Credit systems do not merely reflect a society's hierarchies. They fund them, entrench them, and pass them to the next generation with interest. So by the 1950s, the home had its modern financing. But walk back to the wallet. Nothing in this story has yet explained the card. For that, we need one more revolution, and it started, of all places, with a sewing machine. In the 1850s, the Singer Company faced a marketing problem that sounds like a riddle. It made a machine that could genuinely transform a household's economy. A sewing machine did in an hour what took a needlewoman a long day, and the machine cost more than many American families saw in cash in a season. A product everyone wanted and no one could buy. The solution, popularized by a Singer partner named Edward Clark, was almost embarrassingly simple. Stop selling the machine. Rent it, a few dollars down, small payments monthly, with the payments applying toward ownership. The customer got the machine's earning power immediately and paid for it out of that very earning power. We called it the hire purchase plan. We call it the installment plan, and its descendants are everywhere around you. Pianos and parlor organs followed. The piano in the front room, that great emblem of Victorian respectability, was overwhelmingly an installment purchase. Then furniture, then encyclopedias. Then, decisively, the machine that remade the country. When automobiles arrived, respectable finance wanted nothing to do with lending on them. Bankers regarded a depreciating pleasure vehicle as absurd collateral, and Henry Ford himself scorned installment selling as a species of moral decay. The vacuum was filled by a new invention, the Sales Finance Company, and in 1919, General Motors created its own. The General Motors Acceptance Corporation, GMAC, to finance its dealers and their customers directly. The effect was volcanic. By the mid to late 1920s, well over half of American automobiles were being bought on time, and the car had dragged installment credit from the parlor into the center of the economy. Washing machines, refrigerators, radios, vacuum cleaners, the whole electric household of the 20s rolled into American homes on monthly payments, financed by a swelling industry that barely existed a generation earlier. And the moralists thundered. Installment buying, respectable opinion warned, was dissolving the American character, mortgaging the future for the gratification of the present, teaching thrifts opposite to an entire generation. The debate raged in pulpits and magazines through the whole decade, until a Columbia economist named E.R.A. Seligman published a massive study in 1927 arguing what now seems obvious, that credit which put productive goods into working households was not vice but investment. He largely won the argument. It is worth noticing, though, what the moralists had correctly sensed even in losing, that something enormous had shifted. A nation of cash-and-carry Protestants had learned, in a single generation, to live comfortably in debt. Every future expansion of consumer credit would build on that psychological foundation, and the same sermon against it would be preached again, nearly word for word, at every stage, against charge accounts, against cards, against whatever comes next. It is one of the most reliably recurring arguments in American life, and it has lost every time. One more piece was sliding into place in those same years, in the department stores. Retailers had long offered charge accounts to favored customers, pay nothing at the counter, settle monthly, and as the accounts multiplied, stores in the late 1920s adopted a piece of hardware to manage them. A small stamped metal plate, like a soldier's dog tag embossed with the customer's name and address, kept in a little leather sleeve. The charga plate. Presented at the counter and printed onto the sales slip, it was the physical ancestor of the embossed card. The object itself, waiting for someone to make it universal. All the components now existed. Installment lending had normalized consumer debt. Charge accounts had created the pay later habit and the plate in the purse. Small loan laws, that counterintuitive reform we promised earlier, had starting in the 1910s legalized regulated interest rates high enough to let licensed lenders profitably make small personal loans, a reform championed by philanthropists at the Russell Sage Foundation, who had concluded that the loan shark could only be destroyed by legal competition. And new institutions like the Morris Plan Banks and the credit union movement, planted in America in 1909 with the help of the Boston merchant Edward Filene, were lending ordinary people ordinary sums on nothing but character and cosigners. What did not exist was the connector. Credit you could carry, honored not by one store that knew you, but everywhere, by strangers. Those last two institutions deserve more than a mention, because between them they invented lending on character as a system rather than a favor. The Morris Plan, launched in Norfolk, Virginia in 1910 by a lawyer named Arthur Morris, was built on a proposition the banking establishment considered eccentric verging on unsound, that a steadily employed person of good reputation was excellent credit, even with nothing to pledge. A Morris Plan loan required no collateral, only the borrower's character and the signatures of two cosigners who vouched for it, repaid in weekly or monthly installments sized to a paycheck. The idea spread to over 100 cities, lent to millions, and posted loss rates that embarrassed its critics. The credit union movement ran on the same fuel with a different engine, cooperative ownership. Imported from Europe by way of Quebec, where the journalist Alphonse Desjardins had built parish credit cooperatives, landed in America in 1909. The first, St. Mary's Cooperative Credit Association, organized among French-Canadian mill workers in Manchester, New Hampshire, and was then bankrolled into a national movement by the Boston department store magnate Edward Filene, who spent a fortune and decades lobbying state by state with his organizer Roy Bergengren until a Federal Credit Union Act passed in 1934. A credit union was the old lending circle with a charter, members only, savings pooled, loans granted by a committee of fellow members who knew the applicant, the storekeeper's judgment, democratized and incorporated. By mid-century, thousands of them were quietly financing the working-class household economy. The lesson both institutions proved would become the foundation of everything that followed. Ordinary people, as a class, repay their debts. The risk the old banks had refused for a century turned out to be one of the safest in finance. It had simply never been organized before. The stories say it began with an embarrassed man in a New York restaurant. In the usual telling, a businessman named Frank McNamara finished a client dinner at Major's Cabin Grill in Manhattan in 1949, reached for his wallet, and found he had left it at home. And out of that mortification conceived a card that would let a member charge meals at many restaurants through a single account. The forgotten wallet story is, historians and even company veterans concede, almost certainly polished legend. Great founding myths usually are, but the company was entirely real. Diners Club launched in 1950 with a cardboard card and a couple of hundred members, mostly salesmen, honored at first by a short list of New York restaurants. The mechanism was the true invention. The club billed the member monthly, paid the restaurant promptly minus a discount of several percent, and lived on that discount. Merchants grumbled at the fee and signed anyway, because cardholders spent more. Within a few years, Diners Club counted its members by the hundreds of thousands, and the travel and entertainment card became a fixture of business life. American Express, the old traveler's check house, entered in 1958 with a card that soon went plastic and became the category's aristocrat. The early card culture is worth a snapshot before it vanishes into ubiquity. Diners Club or American Express card in the 1950s was not a mass product. It was a credential, proof of membership in the expense account world of salesmen, executives, and the businessman's lunch, carried with the faint glow of a passport to a certain kind of life. Hotels, airlines, and florists joined the restaurant lists. Competitors sprang up, most stylishly carte blanche, spun from the Hilton Hotel empire, and the industry's entire aesthetic, the club, the member, the privileges, was aspiration by design. Merchants' resentment of the discount simmered from the very beginning, occasionally boiling into organized revolts by restaurateurs. The argument over who really pays for the convenience of the card, the merchant's fee, priced eventually into everything, was born with the industry and has never once gone quiet since. It is being litigated somewhere at this moment. But the club cards had to be paid in full each month, and they lived on expense accounts, the step that created the credit card as the world now knows it. Revolving credit, minimum payments, interest on the balance, aimed at ordinary households, was taken in 1958 by Giannini's Bank in a single California city all at once, in what may be the most consequential mass mailing in history. Bank of America chose Fresno, a mid-sized market where the bank held a commanding share of households, and in September 1958 simply mailed Bank Americards, unsolicited, active, and ready to use, to roughly 60,000 people. No applications, no requests. One morning the mailboxes of Fresno contained a fully functioning line of credit, and the age of the credit card had begun by ambush. The Fresno drop, as it became known, was followed by drops across California and then by the reckoning. Fraud and delinquency ran wildly beyond projections. Cards were stolen from mailboxes and mule-trained into spending sprees. Internal loss figures dwarfed the rosy assumptions, and the program bled tens of millions in its infancy. The bank held on, tightened operations, and within a few years the card turned profitable, at which point every major bank in America wanted in, and the late 1960s became a carnival of unsolicited card mailings, with banks nationwide showering active cards on customers, non-customers, occasionally children, and, in the era's favorite newspaper stories, the deceased and the family dog. Chaos, fraud, and public fury mounted until Congress banned unsolicited credit card mailing in 1970, by which point some 100 million cards had already been seeded across the country, and the point was moot. The infrastructure had been born, competing banks federated their systems, and the two great alliances that emerged, the Bank Americard network, reorganized under the visionary D-Hawk and renamed Visa, and the rival bank consortium that became Mastercard and then Mastercard, wired the planet. The architecture that made the card universal took one more decade of quiet engineering. Through the mid-1960s, Bank Americard was a California phenomenon. Then the bank began licensing the system to banks across the country, while rival banks answered by federating into their own alliance. The association that issued Mastercharge later renamed Mastercard. The rivalry hardwired a two-network world that persists to this day, and inside the Bank Americard system, the licensing era's growing chaos. Banks squabbling over authorizations, settlements, and fraud losses produced an unlikely revolutionary. D-Hawk, a Seattle banker with a philosopher's temperament, who argued that no single company should own the system at all. Under his design, the network was reorganized around 1970 into a cooperative owned by its member banks. No headquarters empire, just shared rules and shared rails, and in the mid-1970s it took a name chosen because it meant nothing and could be pronounced everywhere: Visa. Hawke spent the rest of his life describing the structure as a new kind of organization entirely. Whatever one makes of the philosophy, the machine worked. Authorization went electronic, the magnetic stripe went onto the back of the card, and the seconds-long approval of a stranger's purchase, the miracle this whole story has been building toward, became so routine that no one now thinks of it as a miracle at all. It is worth pausing to notice what actually happens in those seconds. A merchant who has never met you asks a global network to consult your file and vouch for you, and the network does, instantly, for a fee measured in pennies. The storekeepers squint across the counter, compressed to 2 seconds and stretched around the earth. One more date belongs in this sequence, and it may be the most telling of all. Until 1974, a woman applying for a card or loan in her own name could be routinely refused without a husband's signature. Divorced and widowed women watched credit histories evaporate, and lenders discounted a working wife's income by half or more as a matter of policy. Only the Equal Credit Opportunity Act of 1974 made it illegal to deny credit on the basis of sex or marital status. The Universal Card was 16 years old before the law required that both halves of the population be eligible for it on their own names. Whenever this story tempts us to treat access to credit as a neutral convenience, that date is the correction. Access was, and is, a form of citizenship, and it was rationed. Step back now, and watch the whole transformation in a single frame, because something profound happened between the store ledger and the mailed card, and it is bigger than any one invention. For the first 3 centuries of American life, the question, can this person be trusted, was answered by people. The storekeeper reading a farmer's face, the building and loan committee, neighbors all, weighing a member's application, the country banker who lent, as the saying went, on character, and who could afford to, because he attended the same church as his collateral, the mercantile agency correspondent posting his confidential letter. Even the loan shark ran on personal knowledge. He knew exactly where you worked, which was the whole point. Credit was a judgment, rendered by a human being who knew you, with all the warmth, wisdom, prejudice, favoritism, and cruelty that human judgment carries. The system was intimate, and intimacy cut both ways. It could carry a known family through 3 bad years, and it could redline a stranger's whole race by reflex. The card economy required something that system could never supply: trust between total strangers millions of times a day, in seconds. And so, in the decades after the card, the judgment was removed from people and given to mathematics. 2 analysts, an engineer named Bill Fair and a mathematician named Earl Isaac, had founded a small firm in the 1950s selling statistical credit scoring to lenders. For years, most banks ignored them. But scale, regulation, and the mail drop disasters all pushed the same direction. A numerical model does not care about your race, sex, or marital status, which after 1974 was not merely efficient but legally protective, and it can say yes in a minute to a stranger in another state. In 1989, the firm's general purpose score, distilled from bureau files into a single number, was launched under the company's name, the FICO score. Within a decade, it, and the 3 great computerized credit bureaus feeding it, had become the invisible government of American financial life. The storekeeper's ledger, industrialized at last for all 300 million of us, consulted not just by lenders but by landlords, insurers, and employers. And here the story bends back on itself with almost suspicious neatness. The mercantile agency's secret files on 1 million merchants, the modern bureau's files on nearly every adult, the correspondent's unverifiable letter, the database's uncorrected error, the man from Ohio who never saw his file, the consumer who discovers at the car dealership what a number she did not choose has decided about her life. Congress has legislated at the seams. Fair reporting, fair access, dispute rights, exactly as reformers once legislated against the moieties and the salary lenders. The technology turns over every generation. The argument never does. Who watches the ledger, and who answers when the ledger is wrong? As for the balance sheet of the whole revolution, it resists any simple verdict, and honest history should not force one. The numbers on one side are stupendous: the democratization of the home, the washing machine, the car, the college education, the small business launched on a card when no bank would call back, consumer credit as the flywheel of the largest economy on earth. The numbers on the other side are also stupendous. Household debt at scales the moralists of 1925 could not have dreamed in their darkest sermons. The discovery, refined over decades, that the most profitable customer is not the one who pays in full but the one who revolves forever, minimum by minimum. The sweatbox, scholars of the industry call it. The crash of 2008, when the machinery built to make mortgages safe was leveraged into making them explosive, and the foreclosure wave returned like a ghost with better technology. Even George Bailey's institution has a final chapter in this ledger. The building and loans, rechristened savings and loans and swaddled in federal deposit insurance from the 1930s, prospered for 2 generations as the engine of the post-war suburb, then were caught in the interest rate storms of the late 1970s, deregulated into unfamiliar risks, and collapsed through the 1980s in a slow-rolling debacle that ultimately cost the public well over $100 billion and erased most of the industry. The neighborly institution outlived the neighborhood logic that made it work. 80 years after the balloon mortgages detonated, securitized mortgages detonated. The instruments change. The physics does not. So let's answer the title's question one last time, cleanly. Before credit cards, Americans bought homes through building and loan societies, balloon mortgages, and after the Great Collapse, a federal architecture that invented the modern mortgage from the wreckage. They bought businesses with family capital, partnerships, immigrant lending circles, and reputations certified by a private intelligence agency older than the Civil War. They bought daily life on the storekeeper's book, the pawnbroker's counter, and the installment plan a sewing machine company devised. They were never a people who paid cash. That America is a myth. They were a people whose credit had a face. And the revolution of the last 70 years was not the invention of debt, but the replacement of the face with a number, which leaves the reflection worth carrying out of this story. Every society runs on trust, and every society must decide how to manufacture it. The ledger, the lending circle, the building and loan, the balloon note, the red-lined map, the mailed card, the score, each is a machine for trusting strangers, and each distributes its trust unevenly by the values, blindness, and power of the people who built it. The machines we use now are faster and fairer in some ways than the storekeeper ever was, and colder and stranger in others. A number cannot despise you, but it cannot know you either, and it cannot carry you through a bad year on the strength of your character, because it has never met your character, only your history. Perhaps that is the real trade at the bottom of this whole story. We exchange judgment for scale. We got a world where anyone can buy anything from anyone, instantly, and where the question that once passed between two people across a counter, can I trust you, is now asked and answered 1 billion times a day by machines about people they will never see. The founders of Fresno's mailboxes never voted on that world, neither did we. It arrived the way the future usually does. One envelope, one payment, one small yes at a time. If you enjoy uncovering the forgotten systems, people, and decisions that shape the modern world, subscribe for more documentaries like this. Thank you for watching, and I'll see you in the next one.